For the first time in well over a decade, one of the safest investments in the world is offering a serious return. But what if this good news for savers is also a signal that threatens to pull down your stock portfolio and eventually the US dollar itself? It sounds like a contradiction. How can a secure, high-paying government investment be a threat? This isn't about being a bull or a bear, it's about understanding the high-stakes game you're already a part of. We're going to break down this puzzle piece by piece so you can understand the powerful forces moving your money right now. To really get what's happening, you have to start with the fundamentals. When you hear Treasury yields, what does that actually mean? Imagine lending money to the US government by buying a Treasury bond. The yield is simply the annual return you get on that loan. For example, a 10-year Treasury yield recently in the 4.7% range means investors buying that bond expect to earn about 4.7% per year if they hold it for 10 years. Now, here is the fundamental rule. Bond prices and bond yields move in opposite directions. Think about it. If the government issued bonds last year paying only 2%, nobody would want them today when new bonds are paying well over 4%. To sell that old bond, the owner has to lower the price. And when the price of that bond falls, its effective return, its yield, for the new buyer goes up. So, when you hear yields are rising, it means the price of existing bonds is falling. And right now, this isn't just a background number. The 30-year Treasury yield recently pushed above 5.2%, a level not seen since 2007. This isn't just data. It's a clear signal that the fundamental cost of money in the economy is changing in a way we haven't seen since before the global financial crisis. So the logical question is, why now? Why is the US government suddenly having to offer such high rates to borrow money? The answer really stands on three powerful pillars. The first pillar is persistent inflation. Even as it cools from its peak, the risk remains. If you're going to lend your money for 10 or 30 years, you demand a higher yield to be compensated for the risk that inflation will erode your future purchasing power. Second, the sheer scale of government borrowing. The US runs massive fiscal deficits, and to cover that gap, the Treasury must issue a mountain of new bonds. It's basic supply and demand. Based on current projections, net marketable borrowing from private markets for fiscal year 2026 is expected to be around $2 trillion. When you flood the market with that much supply, you have to offer a better price to attract buyers, and a better price for a bond buyer is a higher yield. The third pillar is global competition. The US isn't borrowing in a vacuum. Governments and corporations worldwide are competing for the same pool of global savings. To make US debt look attractive next to a German bond or a high-paying corporate bond, the Treasury has to offer a competitive yield. While these three factors are the primary drivers, it's worth noting that expectations for future central bank policy and shifts in global risk sentiment also play a significant role. Together, they have created a force that has pushed yields to levels many investors have never seen in their careers. This is where the rubber meets the road for your portfolio. For more than a decade, the investing landscape was defined by a simple acronym, TINA, or There is No Alternative. With government bonds paying next to nothing, the stock market was the only game in town for a real return. But now, TINA is dead. There is an alternative, and it's a powerful one. Imagine you have two places to put your money. Option A is the stock market, with potential for high growth but also high risk. Option B is a US Treasury bond, considered one of the safest assets on the planet. For years, Option B paid you maybe 1% or 2%. But now, that same ultra-safe option is offering a return of nearly 5%. The choice is no longer simple. Why take on the roller coaster risk of stocks for a potential 8% return when you can get a nearly guaranteed 5% with virtually no risk? This creates a massive gravitational pull, siphoning money from riskier assets like stocks into the safety of bonds. But the threat is also more direct and mathematical. It's what finance professionals call the discount rate effect. The price of a stock is theoretically the value of all its future profits, discounted back to what they're worth today. The interest rate used for that discounting is tied directly to the risk-free rate, the U.S. Treasury yield. When Treasury yields go up, that discount rate goes up. And when you use a higher discount rate, the present value of those future earnings goes down. Higher Treasury yields act like gravity on future profits, pulling their present-day value down. This hurts all stocks, but it is absolutely brutal for growth and tech stocks, whose valuations are built on the promise of big profits many years in the future. Finally, there's the corporate squeeze. Rising Treasury yields are the benchmark for almost all other borrowing. When the government's cost to borrow goes up, so do interest rates on corporate loans, mortgages, and car loans. This means companies pay more to fund new projects, which eats directly into their profits and can slow down the entire economy. So, rising yields are a problem for stocks. But the title also mentioned a threat to the US dollar. This is where the narrative gets interesting, because it's a two-part story with a major twist. At first, the logic is simple. Higher yields should strengthen the dollar, and initially they do. If the US offers a safe 5% return, that looks incredibly attractive to an investor in Japan or Germany where yields are much lower. A fund manager in Frankfurt sells euros to buy US dollars so they can purchase those high-yielding treasuries. This influx of capital increases demand for the dollar, pushing its value up. But there's a dark side. What if yields are rising for the wrong reasons? What if investors are demanding higher yields not because the US economy is strong, but because they're getting nervous? What if they see the ever-growing mountain of US debt and begin to worry about the country's long-term fiscal stability? What if they see inflation staying high and start to question the government's ability to pay back its debt with money that holds its value? In that scenario, the high yield isn't a sign of strength. It's a risk premium. It's the extra compensation investors demand to hold an asset they see as becoming riskier. If that narrative takes hold, those same foreign investors who were rushing in might suddenly start selling US assets, both stocks and bonds, and converting their money back home. This could lead to the dollar weakening even while yields are high. It's a scenario where the US loses its status as the ultimate safe haven, creating a dangerous feedback loop where a weaker dollar fuels even more inflation. As always, this isn't financial advice. The goal is to provide the mental models to understand what's moving the markets. So, what are the key signals to watch? First, watch the speed of the move in yields. A slow, gradual rise gives the market time to adjust. It's the sudden, sharp spikes that cause panic and trigger major sell-offs in stocks. Second, watch what stocks are doing at the same time. If yields are rising but stocks are also rising, it might signal that the market is optimistic about economic growth. But if yields are rising while stocks are falling, that's a classic risk-off signal, where investors are fleeing from risk. Third, know which part of the yield curve you're looking at. The 2-year yield is highly sensitive to Federal Reserve policy expectations. The 10-year and 30-year yields are a better reflection of the market's long-term view on economic growth, inflation, and, crucially, the nation's fiscal health. So there you have it. The simple fact that the US government is offering a higher return on its debt has created a profound shift. It has ended the TINA era, presenting the first real rival to the stock market in over a decade. This rivalry threatens stocks by making the safest investment more attractive, while devaluing future earnings and squeezing corporate profits. For the dollar, it's a double-edged sword, a source of initial strength that could become a signal of long-term fiscal distress. We are living through a massive repricing of risk, and understanding the role of Treasury yields is no longer optional for any serious investor. What do you think is the biggest risk right now? The pressure on stocks or the long-term outlook for the dollar? Let me know your thoughts in the comments.